So continuing from last week's video, I'm going to explain 3 more investment principles. Again, just to stress, there's no advice in this video, it's just information which is hopefully interesting. As a quick recap, the first 3 principles are 1. Risk and reward, 2. Capacity for loss, and 3. Attitude to risk. Now on to the fourth. The fourth principle is diversification. An investment which is highly diversified will contain a number of different types of asset. Whereas if you just invest in one asset class, there's no diversification. For example, a managed portfolio containing many holdings of shares, bonds and other assets would have high diversification. Whereas purchasing a single buy-to-let property to rent out, that would be low diversification, as you're just buying one asset. Generally speaking, the more diversification within an investment, the less volatility you'll get, i.e. you'll have a smoother ride between when you put your money in and when you need to cash out. This is essentially the theory of not having all your eggs in one basket. There is often a relationship between lack of diversification and increased risk, but it isn't necessarily a proportional one. Investing in just one type of asset could be considered high risk, but if an investor is very knowledgeable in that one specific area, it might be relatively lower risk to them than it is to another person. Again, buy-to-let property investment is a good example of this. It's lower risk if you know exactly what you're doing. Diversification is a principle that is not as intuitive as it sounds. It often catches people out. So I'm going to go into a bit more detail on this and give a couple of scenarios just to challenge assumptions. So scenario 1, Bob has 6 pensions, Sue has 1 pension. So does Bob have greater diversification than Sue? Not necessarily. If Bob's pensions are all invested in the same UK equity index fund, whereas Sue's 1 pension is invested in a managed portfolio including many different funds, then Sue actually has greater diversification and is less vulnerable to changes in the macroeconomic climate. Scenario 2. A lot of you are probably questioning my earlier assumption that a managed share portfolio is a less volatile or less risky investment than a buy-to-let property. After all, a portfolio will go up or down in value over the course of the day, whereas a property is a solid, tangible structure that you can touch and see. But what if you can't get tenants in the property, or they don't pay the rent, or the boiler needs replacing, or the property is damaged in some way? Then the impact on the income generated and the capital value could be huge, and there aren't any other asset types to offset this against. Also, if you, in theory, you've got a different estate agent to value the property every day over the course of a year, you could well see very large fluctuations in value. The 5th principle is the term of the investment. This is the length of time you wish to stay invested. This has an influence on the other principles. For example, if you're aged 25 and saving into a pension, the term of the investment is going to be over 30 years. Therefore, you could argue that in this scenario, you can afford to take a lot of risk and the capacity for loss is high, because you've got a lot of time to make up for any short-term poor performance. As another example, if you're a large lump sum that you have earmarked for a house deposit in 2 years' time, this is a short term. In this scenario, I would question whether any kind of investment is suitable, but if it is something being considered, perhaps it should be low risk and low volatility. The 6th principle is in cashing. That is, at some point an asset will be sold and converted into cash. Until that happens, you haven't actually made or lost any money. It's a consideration in the sense that timing when buying or selling an asset can make a massive difference to your bottom line. That's it for today. Please feel free to add a comment or a question. Thank you.